Welcome back, everyone. I hope you're having a great day. And in this episode, we're going to take a look at 3 high dividend paying companies who have a current dividend yield above 4% and pay a consistent, growing, and safe dividend to their shareholders year after year. One thing I want to know is all 3 of the companies in this video currently have a dividend safety score above 70, which is considered safe by Simply Safe Dividends. That means it's very unlikely that we're going to see a dividend cut coming from any of these companies over the next few years. So what we're going to focus on is go over the company's current operations, take a look at their financial metrics, and of course evaluate the dividend for each of the 3 companies in this episode. But before we jump into stock number 1, I am going to ask you to please hit that like button and subscribe. I'm the Gen Z investor, and on this channel we talk about the stock market, go over different stock market news, and we track the progress of my personal dividend portfolio, which has now reached a value of $170,000. So now we're going to jump straight into the first dividend paying company in this episode, and that is ticker LEG for Leggett & Platt. They currently trade for $35 per share, have a market cap at $4.74 billion, so a smaller company, a current dividend yield of 5%, and a current forward PE ratio of around 15. And if we take a look at a company overview, Leggett & Platt is a manufacturing company. They produce different components that go in homes and automobiles. They're a 139-year-old company, so they've been around for over a century. They have 15 individual business units with over 20,000 employees through the 17 countries they operate within and 130 individual manufacturing facilities. So Leggett & Platt is a global company, although they do trade with a market cap only of around $5 billion. Like we can see, their current yield was above 4%, currently sitting at 5% after the recent share price decline, and they are a dividend king with 51 consecutive years of dividend growth, which is absolutely incredible. They do have a strong balance sheet, consistently growing cash flow, and although the company's been operational for 139 years, they do believe they have consistent growth going forward, and they're targeting between 6 to 9% average annual revenue growth over the long term through organic sales growth and of course acquisitions of other companies. And their 3 avenues for growth, which over the last 139 years they've done very well, is they want to increase their content and new programs to expand their current facilities and the current components they develop, as well as expanding their addressable markets, selling products in new countries they are not already in, and of course they want to identify strategic acquisitions, and historically the company has done a great job of acquiring businesses that provide great synergies to their existing model. And we can see over the long term their dividend continues to grow at a rapid rate, and their revenue diversification is broken up between bedding, flooring and textiles, and automotive, making up their top 3 segments, with home furnishing coming in at 8% of the total top line at number 4. And now if we take a quick look at Leggett & Platt's financial statements, starting off with the income statement, we can see total revenue growth is consistent year over year from around $3.9 billion of total sales back in 2017, all the way up to over $5.2 billion in the trailing 12 months, so continuous expansion of their total top line. And of course, on the balance sheet, the company has total current assets of around $2 billion with total short-term debt of around $965 million. Meaning their current ratio is above 2, so over the next 12 months, they're in a very strong liquidity position. And of course, we have to take a look at the long-term debt as well, coming in at $2.1 billion. And in the trailing 12 months, the company generated $720 million of EBITDA. And of course, if you're unaware, a safe EBITDA to debt ratio is 3. So you want 3 years of EBITDA to cover all the long-term debt on the balance sheet. And of course, $720 million times 3, projecting no growth going forward, is around $2.1 billion, which is exactly what the company has of long-term debt on the balance sheet right now. So I do think the balance sheet overall is in a pretty safe position. And of course, if we take a look at their dividend safety score according to Simply Safe Dividends, the 5% current yield on the company comes in with a 70, meaning the dividend is considered safe at this current point in time and unlikely to be cut over the short or medium term. And over the past year, they did grow that dividend payment by 4.8%, so consistent dividend growth coming from Leggett & Platt. So overall, this is the first high dividend paying company, a current yield at 5%, worth taking a look at for your portfolio if you want a quick bump in your passive dividend income. And now we're going to continue straight into the second stock for this episode, and that is ticker DUK for Duke Energy. The company currently trades for $99 per share. They have a market cap above $77 billion with a nice high current yield at 4.04% and a forward PE ratio of 18.7. So if we take a look at their company overview, Duke is a Fortune 150 company. They have over 8.2 million customers in 6 states for their every month electrical utility business. And of course, their natural gas business also serves 1.6 million customers in 6 different states as well. So overall, they serve around 10 million customers every single month with utilities that need to be paid. That's why utility companies are considered such strong passive income investments, is because their projected revenue and income going forward is pretty stable. Duke Energy knows that all these customers are going to have to continue to pay their electric and natural gas bills every single month, bringing in consistent revenue for the company. And if we take a look at their income statement, we can see just that. Year over year, slight expansion in their total top line. You're not going to see rapid revenue growth from utility company, but we can see in 5 years the total top line grew from 23 billion to over 27.6 billion in a 5-year time span for Duke Energy. And overall, the company does believe they can continue to grow earnings at a rate of 5 to 7% over 2023, and their projections over the long term from 5 to 7% earnings growth through 2027. So for a utility company, those is very strong and consistent growth that I do believe Duke Energy will be able to achieve. And overall, from their latest investor presentation, they believe they can deliver around 10% annual expansion or growth or compound growth for your investment in Duke Energy through around a 4% dividend yield, as well the 5 to 7% annual EPS growth, which of course they expect to be translated into the share price of the company. So overall, Duke Energy believes they can actually provide a double-digit expected return going forward through the use of their expansion in their EPS and their growing dividend. So shareholders overall are expected to get some pretty strong results from a company that's traditionally a boring, slow growth name. And now if we take a look at some dividend metrics for Duke Energy, over the next 12 months, their earnings payout ratio is projected to drop to 73%, which is below the 75% preference for utilities. And we can see over the past decade, their EPS has continued to grow consistently, and they're projecting to hit $5.48 over the next 12 months. And taking a look, the dividend is considered safe, coming in with a score of 80, so again, unlikely to be cut anytime soon. And Duke Energy is a company with their reliable and consistent cash flow flowing into their business. It's a company that is expected to continue to provide a high yield that will grow for investors over the longer term. So Duke Energy, definitely another high dividend paying company worth taking a look at and doing some research into for your own portfolio. And now we're going to continue on into the third and final high dividend paying company we're going to take a look at in this video, and that is ticker VZ for Verizon. One of the largest communication companies in the world, currently trades for $38 per share. They're sitting with a market cap at $160 billion, with a very low forward PE ratio of only 7.35 and an absolutely massive current dividend yield at 6.84%. So this company is always talked about when discussing high dividend payers, because when you have a current yield close to 7% and that dividend is still considered safe with a very minimal payout ratio, I understand why income investors love holding Verizon stock. And if we take a look at their recent performance over the third quarter in 2022, they were able to expand their top line by 4% year over year. So consistent growth coming from the telecom giant. Total revenue in the quarter was $34.2 billion. And if we take a look at the total revenue over a longer term period, during the past 5 years, the company's done a great job of continuously expanding their top line. They've acquired more and more customers year in and year out, and their ability to raise prices over the long term has allowed their total revenue to grow from $126 billion back in 2017 to over $135 billion during the trailing 12 months. So of course, we're not seeing any massive exponential growth in the top line, but year over year continues to expand, which is great to see. And with a company like Verizon, people are concerned with their debt level. Due to the nature of its operations, it requires a high capital expenditure rate in order to fund future growth. This is an infrastructure-heavy business. But if we take a look at the trailing 12 months EBITDA of $43.44 billion, and taking a look at their latest quarterly presentation, total debt on the balance sheet is $148 billion. Their current EBITDA to debt ratio is around 3.3. For most dividend-paying companies, a safe EBITDA to debt ratio is below 3. So the fact that the company's at 3.3 isn't really too drastic above what I would measure as the safety mark of 3 right now. So even though the company is above the metric, they have reduced debt year over year. The company plans to continue to reduce that debt going forward, and I do not think the debt level at this current point in time is of major hurt to the company. And if we take a look at this report from Simply Safe Dividends, they believe that the increased capital spending for Verizon has peaked in 2022. They believe that all the capital spending required to expand their 5G network has already taken place, and that in the upcoming years, capital expenditures will be lower, increasing free cash flow and giving the company their ability to pay back their debt at a faster rate, and also gives them more room to grow the dividend going forward. So overall, they do believe that the current dividend is considered very safe, coming in with a rating of 87. They expect 2 to 3% increases in that dividend year over year going forward. They do not believe the dividend is going to be cut, and considering capital expenditures is likely to decrease over the upcoming years, they believe that's going to provide a great benefit to Verizon investors who are there for the dividend income. So overall, now we're going to conclude the video. In this episode, we took a look at 3 high dividend paying companies that provide consistent and growing passive income into a dividend portfolio. The first one we took a look at was Leggett & Platt, then Duke Energy, and then of course Verizon. All 3 companies provide investors with above average yields that consistently grow year over year. These companies all pay out a safe dividend, which was the focus of this video. Of course, if you want to take more risks and you want to buy a company with a yield of 5, 6, 7%, but the dividend is considered risky, then by all means go ahead. In this episode, we focus on 3 companies who provide a safe dividend that is expected to continue to pay out that same and grow that amount for many years going forward. So I want to thank you for watching the video all the way to the end. Please hit that like button and subscribe if you already haven't done so, and I will see you in the next video.